Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, welcome. We have a huge episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We have a returning expert who always leaves us inspired and excited by some of the names he's talking about. Some of the growth investments that he seems to find always remind us what is possible in the world of investing.
Absolutely.
Michael Frazis, welcome back to Equity Mates.
Thanks so much for having me on again.
So Michael is the founder and portfolio manager at Frazis Capital Partners, and today we're going to be talking about the current market and then turning to two key thematics that Michael is currently investing in, semiconductors and biotech. So can't wait for that. But Michael, let's start with current market. You're up 79% year to date. Congratulations. How are you currently seeing the market though? You know, we're at all-time highs. We're in a bull market. What's your view?
Look, I think we're just in a certain kind of regime, and that regime's been clear we've been in it for about 2 years. It's probably been clear for a year and a half. There's very clear winners. Big tech's still winning as it has for basically certainly my whole adult life, and maybe into the future. Yeah. But it's clear that now there's another huge twist in the sense that compute power is also in immense demand, and the demand for that is way outstripping supply. Now these things obviously self-correct, and they tend to overcorrect, or they almost certainly do in almost every case overcorrect. But right now we're in that environment, and so it should be no surprise, that NASDAQ 100 has done so well, semiconductors have done so well. Yeah, and the broader market has been fine. Actually, it's a big question. Look back to 2022, that was a pretty big crash. Certainly in the tech sector and even more so in the life sciences sector. But there was no real recession. There was 2 quarters of slightly negative GDP in the US. But they didn't even call it a technical recession there. And Australia obviously didn't have one. And then you think about why did that happen? And the answer when you look at the numbers was crystal clear. It was basically a huge amount of government spending. Obviously the stimulus, but then what happened after that? So I'm sure you've seen that data in Australia where, the public sector and NDIS, healthcare, service workers is up, private sector is down.
Yeah.
So it's really been the government spending that's been carrying this entire thing.
Yeah.
And it's relevant when you think about what happens with markets, it's kind of relevant because we're coming into this US election and 2 very different, visions and paths that could go forward. And so I think that dynamic that's killed everything, that's kind of sustained the bull market, has been that extremely low unemployment and the fact that, there's huge amounts of public money being spent and massive deficits in the major economies of the world.
How much do you think about the macro? You're a stock picker at your fund, you're trying to find these fast-growing companies that customers love. And you mentioned there, big tech is the biggest players in the economy now. And if the economy is struggling outside of government spending and, net immigration in Australia, how much do you think about that story when you're thinking about portfolio construction, risk management, how much you're invested, stuff like that?
Look, I think you need to think about it in the sense that there's very few winners at the moment. In the first 10 years of my career, there were just these huge waves that pushed everything up and down. And that's certainly stopped in the last few years. Now the number of winners has really narrowed. So in Australia, if you're on the right side of that government spending, that's really helpful for you. If you're investing in the wrong stocks or the vast bulk or the average company, that's actually not doing so well. And it's the same in the United States. There's a handful of winners, but the market's really narrow. Most stocks are massively underperforming the market. And if you think about fund managers as, roughly, randomly owning those stocks, fund managers are underperforming as well. And really the only people that are performing are the ones that have made big tech their major positions. So in terms of how much do you think about it, I think it's more important than ever to be in the winners and just be in the winners. But yeah, in terms of my process, don't think about it too much. Obviously we do a lot of risk modeling now, and I'm relying on that to keep us out of trouble if things turn. There's been so many twists and turns over the last 5 years. there were various moments where people got it right. Like there were times when I certainly thought I had it right. And then maybe the next twist and turn you don't see. And you almost don't want to get too many of these things right because it'll give you false confidence. Then the big one's going to be right around the corner for you.
Yeah.
So in your latest shareholder update, you actually said if the season changes, we'll be using tight risk management to protect our portfolio. Best case scenario, we will rip another 4 times out of the sector.
That's a bit. I think I was just trying to leave it on a punchy note.
Well, it's certainly got our attention.
No, what happened is, we had a big, so we also invest in indices as well. And we had across our basket of semiconductors, we put a 4x profit target. And that's kind of an empirical thing. You know, I went back through all the stocks and I was like, what if we sold at 50%? What if we sold at 2x? What if we sold at everything that doubled, everything that tripled, everything quadrupled? And the answer was crystal clear. Like 50% is not enough, which I knew and you probably know as well. Like if you just sell everything that goes up 50%, you lose too much money on everything else. You know, you're never really going to outperform. But it was interesting to me to find out the optimal was actually 4x. But there's kind of a trade-off. Once you get above kind of 2 to 3x, once you get to that ballpark, there's a bit of a trade-off because if you sell sooner, you're holding cash for longer periods, your volatility is way lower, and it obviously happens much more often. So it's much better in terms of like a volatility perspective. But if you actually want to maximize returns, you go for 4x. And that's kind of what we did in semiconductors early in the year. And we hit it, and it was a few days from the top. I mentioned it before, it was obviously a luck, but it was kind of luck, but it was also kind of weird that it worked. And so that's what I was referring to. So now we're back, now that trade's basically gave a buy. There was like three months of selling. Sorry, semiconductors sold off for longer than 3 months now. They're still well off their highs. They must be still over 20% off their highs, the semiconductor index, from June, July. And so now we're getting another set of buy signals. So we're kind of hoping that there's another rip over the next year or so.
It's just crazy. I think back to that NVIDIA sell-off. It was like 20% down in less than a week in early August. It's just like, it was a screaming opportunity.
Yeah, it really felt like one of those moments where everybody who wanted to buy it had bought it and there was just nobody left.
And
there was it wasn't like there was a huge amount of short interest or anything to keep it going. Yeah, it was just one of those moments in time.
Yeah. Well, let's talk about semiconductors in particular and the broader like cloud compute AI story. And it's funny, it feels like every expert that comes in here, everyone has a theory on it. Everyone's got a take on it. Some of the ones we're hearing recently is the only way to play it is NVIDIA. We're hearing some people say that the actual providers of these AI models are just going to be commoditized. We're hearing some people say you can't invest in it because it's going to be like the internet where like the benefits are going to be disparate across every company, and like a lot of early internet winners didn't actually become the eventual internet winners. We're hearing every theory. So before we get into specifics about how you're playing it, just generally, how are you thinking about it? What's your theory on the whole space?
Look, it's pretty clear. Again, going back to that point that we've got a really narrow market, it's crystal clear that there's only a handful of winners there. So NVIDIA's one, they're capturing the lion's share, 75% margins plus. Their competitors are nowhere near that. And then, NVIDIA's grown extremely strongly. In GPUs, their closest competitor, AMD, has barely grown at all. That obviously GPUs have grown, but there's been weakness in the rest of what they're doing, and that's pulled the average way down. So there's only been one like ultra high growth winner. It's also got the highest margins. I think you just keep it simple and don't overthink it. And everybody, whoever wins out of the models, whoever wins kind of further down, they're almost certainly going to have to use a huge amount of compute. And NVIDIA has a vast lead in that. And they're investing heavily, in R&D as well. So they've also got the biggest R&D budget. That's no guarantee they'll stay on top, but it's a good indicator, particularly in this industry where it's not like software where anyone can just spin up a product. A huge amount of investment needs to go into it. Now, I used to think of it then, Taiwan Semiconductor makes the chips and then ASML makes the printing, the lithography machines that TSM buys. But ASML had a surprisingly weak result. So firstly, they've been hit by sanctions from China. Secondly, there's been weakness in the broader semiconductors coming, which is like, phones, PCs and autos. People aren't upgrading as much, and that hasn't changed yet. People, myself included, thought that would have changed by now, but people still aren't upgrading. I've still got a phone from a few years ago. There's just no reason to upgrade that square to another. Sorry, it's a rectangle, isn't it? Yeah, it's basically the same form factor and does the same thing. So there's very little reason to do it. And also the third point, which is interesting and comes back to your question, is that it looks like Taiwan Semiconductor is squeezing them a bit on margin. And similarly, they're trying to push back as well on NVIDIA. So right now, there was like this all three of those were going great, and now there's a bit of tension in those relationships.
Yeah.
And it will be interesting to see where that settles. But in terms of who really has the power, it's probably Taiwan Semiconductor and Nvidia. Taiwan Semiconductor was, I think, at a P of just over, like very low double digits. Not that long ago. Like that was the screaming buy as well. And that's gone from, $80-$90 to nearly 200 now. And I think that's, if you're looking for like kind of something steady that will capture the wave, that's another option with Nvidia. Yeah, there's other points like large language models. They're obviously all fighting it out. They probably will be commoditized. In that bunch. They're giving the similar answers. They're having to take different strategic moves. So, Google and Gemini have obviously become extremely politically correct, but that's firstly weakened the quality of the model, but also means that you can't use them for things like politics, even history, because there'll just be a lens in. Whereas, say, Elon Musk's XAI doesn't have that lens. So interesting to see that's a dark horse that comes up. But at the moment, in terms of market share, it's still basically ChatGPT as the clear winner. I personally don't really understand what happens below that. I don't, beyond the top 2, 3, Meta's Llama, obviously Amazon and Anthropic have their hat in the ring. ChatGPT is just dominant and about to launch a new. I just don't see what happens to the 4th, 5th, 6th, 7th, 8th, down to the 50th large language model. And I think the consensus in that industry is that basically it's going to come down to a few foundational models, and all the new startups will stop training foundational models, but they might, pre-train those, take those as a base and then train them further, particularly if they're open source, particularly the open source ones. The other thing that's happened was the latest update in OpenAI added this additional dimension to compute, which was like they extended the amount of time that you spend thinking about a problem. So you could people that were using these models were replicating that anyway. You ask ChatGPT something, then ask it again, is it correct?
Yeah.
Just asking it twice would improve it. Or if you say, why don't you write out a plan to build a website? Okay, why don't you give me the step 1 of that? And then step 2, okay, now debug this. We're already doing that just kind of manually. They've now productized it. And if you ask the leading model a question, you'll actually see the steps that it's taken.
Yeah.
If you think about what that means, you obviously have that scaling factor in the terms, the more compute you apply to training, the better the models do. That's still true. And that's why the bull market is still in place, because there's still very visible, obvious benefits to applying more compute to the problem. So the next generation will have to invest, an order of magnitude more to get, those increase. So that's one scaling vector. The second scaling vector now is just letting them think for longer in inference. And so it seems like every time it looks like you might be hitting some upper limit of demand, there's like a whole nother dimension in which it's going to grow. Yeah. And that's almost certainly going to be the case in that. There's a third one that's on the horizon, and that's agents. That's like when you get an AI to kind of book something, and what we'll probably be doing is speaking to another AI. So you'll use a booking agent. Your agent will speak to a booking agent. Will find you the best flights, the best hotels. They'll be speaking in whatever language they choose to speak in, probably starting with English.
Yeah, all that customer service stuff.
Customer service as well. Yeah. Getting your agent to speak to their agent.
Yeah.
Getting your agent to then find the best price or the best product and handling negotiations for you.
Wait online to buy Taylor Swift tickets.
Yeah. I remember.
Stuff. Yeah.
I remember like 5 years ago, Sundar Pichai at a Google product launch thing had this video where he had Google AI book a hairdresser appointment. Does this ring a bell with anyone?
It kind of does.
I think I remember that, yeah. That's it. It's a feature.
And at the time, it kind of blew my mind, and everyone in the crowd was losing it. And then nothing really happened. This was pre this whole COVID and then AI boom. But it now feels like now's the time where we're going to be booking hairdressers with our AI agent.
Yeah, it's coming. I think it's going to be one of those ones where
you guys.
Now there's a lot of startups doing it, but I reckon there's a lot of risk in those startups because the big companies will just do it better. But they've got to be so careful because you're to make them work, they need to have access to your payment details. They need to know all your information.
True.
It's going to be, there's a lot of hurdles to cover. Like obviously a startup, the technology is ready now, really. But it'll be the big tech companies that probably have the best versions if they can get around those hurdles. At the moment, they're flagging that it's coming, but you can just see how slow these things are moving. Like the products are way behind the leading edge of technology. But again, if every person has multiple agents, every company has multiple agents, speaking to thousands of other agents, that's another scaling vector in terms of compute demand, which is why like long term still confident in that, albeit obviously we'll manage it with risk, but there is still like that long term bull case, and that's kind of intact for compute.
It feels like though everything you've just said, like the ability to invest and get increased compute power and everything that you just said really is just a big old wind up to say buy big tech.
Yeah. Well, it's funny, I remember 2012 people talking about this stuff, it's actually relevant. There's one thing I think about often is when Apple became the biggest company in 2012. So everyone's been umming and ahhing about whether or not to buy big tech. In my world, in the professional world, your entire performance depended on your allocation to big tech. Not necessarily in kind of like boutique funds like mine where you're trying to do something very different. But in those big fund managers, it's like however much you allocated to big tech was how well you performed. That was true 15 years ago. It's true today. And that even goes to, I don't know, funds like Magellan. It's like the more they allocated to tech, the better they did. And when they kind of tried to be more generalist, they just kind of joined the vast majority of companies in the S&P 500, which underperform. Because it's only been those handful of companies, that really narrow leadership that's driven it forward. And yeah, I think from 2022, it was pretty clear that those big tech companies were taking cost cutting seriously, particularly Meta, that huge cost cuts there. And they really kind of unlocked the amount of value they're really creating. I'm in the camp where I think like fund managers probably shouldn't do too much of that stuff just because, find something different.
Yeah.
And I think also the indices are just so well structured because they're market capitalization weighted. So the winners continue winning. You don't trim or do anything like that. If there's a competitor, it typically comes up through the index. So if you think about what happened when Google and Facebook took over the entire advertising revenue stream, it was more than that. They became like an expense line in almost every company. Certainly every consumer company started paying this toll to Google and Facebook for advertising. That came at the expense of every other company to the benefit of like these two. But on an index perspective, they shot up. The index shot up because those companies came up through the index and pushed it up. So why indices go so good? Because occasionally there's one or two companies that just imply a cost to every other company, like Google, Facebook. Actually, Microsoft is another really good example. Like every office worker has to pay them $60 to $90 or whatever it is a month. And they're just collecting that as a tax. Yeah. So, if anytime somebody does that, that's an expense line for everybody else. But it's revenue for them. And so they push up. If it's an active manager to do that, you'd have had to have just been in those and effectively de-weighted everything else proportionally. I mean, I certainly believe you can get those calls right a few times. Long new tech, short old tech, long Google, short newspapers. You can definitely get a few of those, but to do those consistently over time is extremely difficult. If you want to play that game where you're, I don't know, the ASX top 50 or the S&P 500, you have to get those right all the time.
Yeah.
Whereas the index investor, and I'm sure you guys are advocating this as well, the index investor gets the benefit of that. Every time some company comes in and like becomes a cost for everybody else, they shoot up.
Yeah.
And then I'll give you a recent example of that, and that's NVIDIA. So their revenues have exploded and they've now become a tax that every big tech company has to pay.
Yeah.
So Google, Meta, Microsoft, Oracle even, all these companies now have to spend huge amounts of money on NVIDIA that all things equal they wouldn't have done without this AI revolution. And they're doing it at a very high margin as well. And they don't want to do it, and we know that because they're fostering competition AMD, they're trying to design their own chips. They're doing whatever they can to kind of bring that massive profit margin of NVIDIA down and have alternatives in a competitive market. But it's just another example. One company has come in, incurred huge cost on everybody else, and the NASDAQ is just lifts up again.
I love that you've spoken about that. We speak about how elegant indexes are, but we speak to a lot of active managers, and no active managers ever want to give the index credit.
No.
They want to sell their own way of investing. But I love the fact that you've just come here and made a very compelling case for index investing. We know that Bryce asked that last question, why wouldn't you just invest in the Mag 7? But we know that that's not how you're investing and how you're playing this trend. So alongside maybe a core allocation to an index product, you're obviously looking at different parts of this market, different winners. So where are you seeing winners in the semiconductor and AI space?
I think there are ways to outperform. Like I've gone through long periods of outperformance. You obviously had one bad year, which took a lot of that away. But it's we went up it was something like 12 times over 8 years, and the index did nothing like that. And I think so. It is possible. I think with our current risk thing, if 2022 came along, we'd probably do extremely well. But, one ways you could do it is like companies that are consistently growing faster, than other companies. At least you've got the raw ingredients for value creation. At least if every company you own is twice the size in 1, 2, 3 years' time, there's a good chance, value creation has matched that. And that's going to be way ahead of the index. Even value investors probably do something similar. They're just going to buy something that's earning more than everything else. The earnings yield is higher, the cash flow yield is higher, and they expect their returns to be higher. There's obviously reasons why that doesn't work, but, the style that I choose is that these ultra fast growing companies. And, they've been pretty successful. So, Transmedics was up quite a lot. We sold a lot of it. Yeah, we probably sold half of it, around 2.5x. If you looked at what are the top picks in semiconductors, you could use that same lens. So what was the fastest growing company? It was probably Nvidia. And if there's smaller companies, they probably also posted high growth. Which ones disappointed was the ones that didn't have that growth lens. And, with you guys, I've talked about like that true love component. It's like true love and explosive growth. Everyone you speak to in the industry will talk about Nvidia. It's the best. They love it. They can't wait to get their hands on it. They just wish they had a higher allocation. It reminds me when people were queuing up outside Apple stores, when there was like a 6 to 12 month waiting list to get a Tesla. It's kind of like that with Nvidia now. So it's really, of all those companies, it's the only one with that true love. And the explosive growth was higher than certainly all the large cap companies.
Yeah.
So again, it's not easy to pick the top stocks in anything, but that lens once again led you right to Nvidia, a year and a half ago.
Yeah.
A long time ago. Certainly at the beginning of this year, that was all crystal clear. And they've done exceptionally well, and it's still kind of in place now.
So one company that, based on your recent investor update, I think you're looking at or you own is NeoClouds.
Yeah, we don't own them. I think NeoClouds are basically, in that context, these are people that are buying NVIDIA GPU capacity and then leasing it. So I'll explain that. So it's basically, Microsoft is even using these. So Microsoft has their biggest, baddest company, and they're building their own data centers. They're still using these NeoClouds. Companies like CoreWeave. So what they've done is got their hands on GPUs, done all the infrastructure so they can be leased easily online, over long periods, short periods, scale up, scale down, take that excess capacity. And they've grown extremely fast on the back of it. Okay. And there's such high demand, such a mismatch between demand and supply, that, they've done exceptionally well. Now that is where if the turn comes, that's where it's going to hit. Yeah. So analogy I was thinking about this morning was, do you remember Emeco and like Boart Longyear, and do you remember like the mining services boom, like maybe 10 years ago?
No.
Maybe not. Basically there was a boom, I think it ended around 2012, 2013. It was the same thing. It was like big tech the big mining companies going exceptionally well, like BHP, Rio. But there was more demand than there was supply. And it kind of bubbled out in weird ways. So one of the ways it bubbled out is that like executives would leave and set up consultancies. It's like, why am I earning a few $100K at BHP when I can set up a mining consultancy and earn a few million a year? So there was a lot of that. There was also like all these supply companies that came on and would lease like excess equipment to, whether it's drills, whether it's, excavators, whatever it is they need, they would lease those to the big mining companies, big and small. And you've got that now where there's this excess demand and there's people that have got their hands on some of this supply, and they've set these like ancillary companies, but really they're just like that lever. There's like this demand and then there's like this excess bit. And these are like the excess supplier of excess demand, but they're also, when demand comes down, they just get cut. Your consultancy agreement doesn't get renewed after 2 years. When BHP and Rio went through their big cost cutting processes, first thing they did is like wipe out all the consultancies. Obviously there's less growth. They don't need that excess capacity. So all the excavators and the drills go back and they get mothballed. There's nobody else wants them. And then those stocks were absolute catastrophes. They had to be restructured. They had to mothball a lot of equipment. And if you think about what will happen with these NeoClouds, it's basically right now business is amazing because they can charge whatever they want, not necessarily whatever they want, but they're like that excess capacity. They've got what everybody needs. Business is good. But if demand slows down, and it'll manifest in a few ways, maybe the next training model is only marginally better. And it doesn't make sense to train the next one even more. Or there's enough existing compute for people to do the training. And maybe it is getting vastly more efficient to do inference. There's a lot of research being done. How can we make it even faster, even more efficient? Maybe that hits a point where you have like this excess supply dumping and not enough demand because everything's become so much more efficient. When that happens, then people are just going to switch off their contracts with these NeoClouds. And they'll be left holding the bag. So effectively, if you think about it, they're taking the long-term risk of of holding all these NVIDIA chips. Everybody else is just using them short term to take the excess demand. But if they cut that off, well, they're the ones that are taking the long-term risk on what is the value of a chip in 3 years' time. So it's really relevant now because they're providing a lot of the excess demand to NVIDIA and the semiconductor supply chain.
Yeah.
And, there's these weird circular arrangements where NVIDIA's invested in them. They've bought chips from NVIDIA. It's weird circularity.
Yeah. $900 billion funding around, $800 billion of it goes to NVIDIA chips. Those are extreme
and it optimizes
numbers, but
their revenue and their profits. Like, why they do that? If you think about it, how does it work? I guess NVIDIA's lending their balance sheet to them. They're taking the long-term risk. NVIDIA's banking they're going to get most of their money back anyway by selling their chips. But yeah, it'd be interesting to see if those things unwind, because there's some people that think that's kind of goosing up NVIDIA's revenue excessively.
Yeah.
Like if you lend someone money to buy your product, it's a fine accounting line, right?
Yeah. It's fascinating. So we want to talk about biotech. So I guess just, do you have any closing thoughts on this space? Anything that you're watching either as like a, I don't know, something that's exciting you, maybe something you'd be watching as a lead indicator that the sentiment's turning?
Look, you can see the rental prices online. Like you can go to like vast.ai and just see, you can rent a GPU at a price, and you can see that's gone, from $6 to $2 pretty recently. So that's definitely come down. There's a launch of the new Blackwell chip. It'll be super interesting to see what that does. And when all this new compute capacity comes on the market, what does that do to pricing overall? And certainly what does that do to the H100s, and the A100s, the previous generations? Do those things just collapse because there's a more efficient version that everyone's using? And a lot of them. So that would be interesting to watch. The energy space, I'm kind of kicking myself because I wasn't really on it. Wrote about it many times. This is all going to use a huge amount of electricity. But there's been a bit of like a momentum swing in like nuclear stocks and things like that. Crazy, and that's happened. I haven't really been a part of that. I don't really want to kind of jump on now. There's definitely something there. And there's been a shift in terms of the acceptability of nuclear. But yeah, other than that, I think we're in this regime of more and more compute is better. And so, there's going to be twists and turns. But I don't see anything at the moment that would shake you out of that regime. The regime will change. But as of today, you don't see it.
Yeah. Trends last longer than you think. So let's turn to biotech. We'll start broad, high level. What are the trends and the business models that you're currently sort of focusing on in this space?
Yeah, look, I think it's interesting because biotech had a worse crash than tech. And now Australia's in a really interesting position in the biotech world because basically we have one of the cheapest ways of doing phase 1 trials that the US will accept. So obviously you can do cheaper trials. How's that? They respect the science. They just respect Australian trials. Obviously, the medical centres we have here are world class, in line with the best in the world. So they're accepted. If you go to phase 2, then you need to do more. The FDA asks for a lot more. A lot of it's around like little things like manufacturing, for example. That has to be done in phase 2. That has to be done to a specific standard, whereas in phase 1 they won't necessarily require that in Australia. Right. It's lower cost.
Okay.
There's also huge tax incentives in Australia. You've got that R&D rebate, so you're basically getting 43% of it back, which is huge. And if you see any of these companies, they have it. Did you guys see that newspaper article where it showed who the biggest recipients of that were?
No.
It was like companies that you wouldn't expect. It was like casino like gambling companies and stuff like that.
Tax rebate.
Yeah, they're just spending money on R&D. I mean,
Aristocrat is maybe going to get cut off.
Anyway, that stuff drove me nuts. Yeah, I know, because we have a little VC fund, so we see a lot of startups, and often that's the only thing of any value that they've got. It's like this R&D rebate that'll come, and whether it comes or not is an open question. And that has created huge distortions across the market, and it's definitely been abused massively by companies as well. Yeah, I guess it comes back to that spending of money that we were talking about earlier and the impact. Anyway, to bring it back to biotech, won't go down that tangent. To bring it to biotech, there's huge incentives for phase 1s, and you're coming off the back of a huge crash, which knocked prices all the way down. Basically, in the US, if something developed a drug, the returns weren't 2-3x, they're 10, 15, 20x, because you're coming from such a low level. And you've kind of seen that in Australia too. There's been a few massive winners, which have kind of, if a company goes from 300 mil to 3 bill or 6 bill, that's a lot of money on people's balance sheets here. That's a lot of funds that have succeeded. That's a lot of people that were pro-biotech that are now looking very good internally, raising more money, getting allocated more internally. You don't need that many winners to create that effect. And I think we've got that. So you had Neuron, which went from, $1 up to whatever it is now. I think it's $12, but peaked at 24. That's an example of a company that brought a drug to market, now getting significant revenues. In radiopharmaceuticals, you obviously had Telix, which started with an IPO, again, right at the floor, and is now doing, hundreds and hundreds of millions of dollars of revenue and a huge research pipeline as well. And that's kind of reminded everybody what the sector can do.
Yeah.
So there's a few companies, that are kind of coming up. I'm kind of wary. I don't think these are necessarily stocks that people should be piling into.
Yeah.
Because I think everybody thinks it's like, it'll go up 10, 20, 30x, or you just lose your money. So it makes sense to make that bet. But generally it doesn't, because typically you'll find yourself in the one that, fails. And I don't even really believe in that approach anyway. I think you should actually be convinced that something works.
Yeah.
And if you're very convinced it works and you kind of know what you're doing, there's a good chance it should succeed. Yeah. So I'd say radiopharmaceuticals probably was in that category. If you're curing a small number of people in a way that's very well understood, there's no reason not to think that's not going to continue. And that's exactly what happened. Certainly with Clarity, with that early data has followed through to the later stage data. Telix, similarly, once it rolled out, once the product was working, there was no reason to assume that it wouldn't just work and be rolled out. I think what's taken everyone by surprise in that space is how much demand there actually was for their imaging, because basically people getting imaged more and more often. The problem is it's not the best test. So there's still this immense demand for alternatives. So in terms of like where you would go in Australia, look, there are a couple of raises last week, which are interesting.
Yeah.
So there's Orthocell, which is doing kind of nerve repair. They're doing maybe, I think in the last quarter, they had 2 mil of rev. So if you analyze that, it's 8, but they're about to roll out to the United States. So in the latter stages of getting that ball rolling, if that happens, that's a $30-40 million US opportunity. So say 50 to 60 million Aussie if they get 20% of the market, and it's a $140 million market cap. Obviously they get more of that. That could do exceptionally well. There's precedent in Australia. Companies like Polynovo went to multi-billion dollar valuations on $50-60 million revenue. And actually, obviously that stock hit that level way too soon, but then the revenues did come and that valuation has come down. So I wouldn't say it was necessarily massively incorrectly priced. That was Orthocell. I could definitely see that going. They're approved and selling already. So it's the same kind of thing. It's like it's working in some markets like Australia. So it seems like a reasonable bet that will work in the United States and they'll just roll it out in a market that's not 20 times bigger. In this case, because there's like gunshot wounds, stabbings, more accidents, things like that. It's actually much, much bigger. There's something called EBR, which is like a heart device that just got approved they just completed their trial and should get approved in the United States. That will then roll out. And again, that's, very small company targeting a huge market. If that rollout succeeds, that will probably be, one of the top performing stocks. There's an interesting one I saw last week as well, was Oncosil, which was in the market for pancreatic cancer. This has been in the market for a long time. It's one of those ones where if you mention it to any fund managers, kind of roll their eyes because there've been so many cap raises. It's like, oh, what are they up to? Now they've treated 200 people. It's being used. It's basically radioactive particles. So coming back to radioactivity, that they inject into a tumor. So if you have pancreatic cancer, it's known as one of the worst. The good news is that it generally happens quite late in life. Like 60s, 70s, 80s. But if you get it, the 5-year survival is 10%. Yeah. There's the only disease modifying cure is surgery. And often it's found too late. So it's too big, you can't do the surgery. The pitch for this is that their data shows that if you inject these radioactive particles into the tumor, it shrinks the tumor. And then they're saying in these inoperable cases, which is most of them, they're pushing survival from 10% to 50%.
Wow.
5-year survival. Yeah, but again, this is company data. There's caveats. It's only been in a couple of hundred people. But, it's already started rolling out and should soon be rolling out in the United States as well, which again is the biggest market. I think these things you kind of watch out of interest. Yeah. The risk reward investment is when the revenues start coming in. So, the ramp up of Neuron's revenues, there was plenty of time to make a lot of money. Similarly with Telix, the ramp up of Telix revenues, when you knew it was beating, you knew it was in market, it'd been approved, that ramp up, there was a huge amount of money to be made. And you didn't have to be a biotech specialist because you can say, well, I can see that the surgeons are using it. Yeah. I can see, in this case, I can see the oncologists are using it. I think that's where it makes most sense. Even the ones that I'm like really interested in, I'll often put them in the too hard basket until you see, is there end demand there? If the end demand's there, then you can jump in pretty early and, ride that wave up. Yeah. And that seems a much better risk reward prospect.
I think it's worth for people who are new to you, Michael, saying that you're putting biotechs in the too hard basket and you studied chemistry at Oxford. So for some of us that don't have
No
a scientific background, it's being aware of like where your circle of competence is and like what is too hard at certain points, because it sounds like, you're doing that and you're much more
definitely.
technically.
I mean, I defer to experts at all times in these things anyway. So I wouldn't consider myself an expert in any of this stuff. But I'll definitely get that expert advice. Like the experts don't know what's going on most of the time. Like that, and that'd be the first to admit that they don't know. In these companies, they don't know which one of their programs will succeed. It's huge debates internally, and often they make huge investments and get it wrong.
Yeah,
and they're the people like at the actual coalface. So there's also an element, like a lot of these things are unknowable. Like human biology is still very unpredictable. But yeah, when it comes down to that simple analysis, those ramp ups can be really good in healthcare.
Yeah.
Really strong.
So speaking of ramp ups, let's go from the small end of the market to the big end of the market in the biotech space. At the start of this year, you joined us on Equity Mates to talk about GLP-1 drugs, Eli Lilly, Novo Nordisk, Ozempic, everything that's happening there. And you said at the time that often the first drug to market that captures people's attention isn't the eventual winner. And if we look really since June, Novo Nordisk is down 25%. Eli Lilly in the last 6 months, I think, is up about 20%.
So that would be an easy one.
That would be an easy one.
Well, basically you could see that Mounjaro was taking over Ozempic.
Well, this is what I wanted to ask.
Yeah.
Is Ozempic getting kicked off its perch?
Yeah, I mean, Mounjaro is better. It's lower side effects and high weight loss. It's kind of 15 to 18% for Ozempic, I think, last time I checked, and kind of 18 to 25% for Mounjaro. But Ozempic got the brand name first to market, but they're not the best.
They also had that really catchy ad in the US. If you Google it if you haven't listened to it.
What is it?
It's I'm not going to sing it, but Google it in your own time. It's good.
That is often the case, and it will certainly be the case this time. And it won't be Mounjaro. I reckon it'll be a pill that will end up being most successful.
Pill?
Yeah, I reckon a lot of people are holding back because it's an injectable subcutaneous injection. Even though it's just a little pen, it's still, most people don't want to do that.
Novo Nordisk, I think I read, had their stage 1 trials of the pill and they were losing more weight than their injectables. So it was more effective as well. Obviously,
I think the next generation will be good. But, Ozempic is already in pill form. But they never marketed it properly, only to certain people, because basically you need to take a lot of it to get through your digestive system. And so because there was a supply restriction, they didn't want to do that.
Right.
It made more commercial sense for them to give out like smaller doses, subcutaneous, particularly because the take-up was so strong already. There have been many drugs that have caused weight loss. Like this has happened many times before, but in the past, there was always like some health scare afterwards, often even after it was in the market. So, there was like fen-phen, there was obviously the amphetamines. There's been a number of these things. There's one that gave like heart attacks, but it only came out after. So that's why everyone was so careful. Everyone was like, okay, we've seen this many times before. Let's wait. Like there will certainly be, like, what's the catch? We're just going to wait until the catch comes and everyone's going to have some horrible side effect after 5 years. But in this case, that hasn't happened. And, these drugs have been in the market a very long time because they're in the early generations were in, 15 years plus. There's been 10-year trials of these drugs, and those negative side effects just didn't come for whatever reason. And in fact, it was the opposite. It was actually huge health benefits across the board.
It's crazy just like the amount of studies that we see. It's like, Ozempic might help with addiction to, like alcohol and stuff like that. It might help. Well, like there's been the kidney disease studies and there's been the sleep apnea studies and like some of those are obviously related to weight, but it's just like, I feel like every week there's another study that's like, GLP-1 drugs might help with this as well.
Yeah. I mean, what does it do? It regulates blood sugar and drops your weight. And so there were a lot of people that used to say that blood sugar, kind of like the wacky, or not necessarily wacky, but popular science. Those books are always like, it's all about blood sugar. It was like a big thing in like the dieting world. And it looks like there might be a lot of truth to that.
Okay. Yeah.
Maybe it's just the books that I was reading.
Yeah. I can't say I've read them, but
yeah. But it seems like every health effect you'd expect from weight loss has occurred. It seems like in addition to that, there might be more. That's when it gets harder. Like, are there effects in addition to what you would expect from losing 15 to 25% of your weight loss? That's a harder question.
So is that a place you're playing in from an investor standpoint, GLP-1?
Not really. It just seems a bit mature. I mean, we're kind of on the pointier end of things.
There's no Forex in Eli Lilly.
I think
Never
Bryce,
say never.
Bryce at
I'd
the
be
start of the
surprised.
year predicted Eli Lilly at $1 trillion. Was that right?
Whatever it would have been, yeah.
And we were all like, oh, that feels pretty aggressive. It's up 50% year to date, and it's an $850 billion market cap.
Not bad.
Should have put your money where your mouth was.
Not bad.
Pretty good return.
Pretty good return.
Not
yeah.
quite 4x though.
Not quite.
Not quite 4x.
Just to close out the biotech side of things, like, you have this framework of customer love, rapid growth. A lot of the companies that we're talking about, probably aren't at a stage where they can have a lot of customer love because they need regulator approval before they can have customer love. So is there anything that you're seeing that is starting to show those hallmarks of rapid growth and customer love that have like got through those regulatory hoops?
There's a couple in the United States that are growing pretty fast. We've been in Transmedics for a while. This morning they came out with a bad result. So it feels weird talking about it now, but it's still well up a lot. And again, it came back to that model thing, hitting the 2.5x and you just sell half of it. There's no way I would have done that without a quantitative approach. So yeah, it's bailed us out of that situation as well. Not entirely, but at least partly. I reckon there's enough. There's a couple of coming through the pipeline, which I just mentioned in Australia, that are at that approval stage or just post-approval, or they've been approved around the world, but not in the United States. I reckon those you could then see that explosive growth. And actually the customer love thing is really important for that, because then if you need to speak to the actual practitioners that are going to use whatever it is, a device, a drug, and if they're excited about it, that's really good.
Yeah.
If they've never heard about it because some random Aussie thing that's done a trial, often on the ASX there'll be a company that's done, 20, 30 patient trial, a small trial. It's not convincing enough. Maybe they've seen some signal, but it hasn't set the world on fire or like that particular world on fire. Nobody's really heard of it. It's not relevant because until it's repeated in hundreds or thousands of people, US physicians are not going to change their mind. So trying to figure out what they're really excited about it's kind of a similar approach, right? You're approaching it from the customer side. Will they get it? It's like a lot of companies don't do head-to-head trials in biotech if they can avoid it, because it's much easier to kind of prove that it's better than nothing, or better than not necessarily placebo, but a standard of care, not better than the next best thing. And so there'll be games played where you might use like just chemotherapy, but not this new agent that's hit the market. Or you might use an old chemotherapy agent or something. You won't necessarily go head to head.
Yeah.
Like has Tilix gone head to head with Lantheus? They're generally trying to avoid that thing.
Yeah.
Actually, on that point, it'll be interesting because Clarity's going to have to, because Clarity's coming up into a mature market with two big existing players. If they want to get any revenues in that, they're going to have to convince the physicians. And to convince the doctors, they're going to have to go head to head with Tilix and Lantheus and like kind of definitively prove that they're better, which is obviously high risk. Because if they didn't do head to head and just prove that it worked as an imaging agent, which they can do, then they could market it, they could spin it, they could still try and get some market share. Head to head, if they lose head to head, then there's no reason for anyone to switch from what they're doing already.
Yeah.
But yeah, I think they're going to have to do that if they want any serious revenues. There's a few, I'm not sure if that was an answer to a question.
Yeah, no, it's interesting. Now I'm just thinking I want to see head-to-head trials in other industries. Just like companies putting it on the line, being like, we make a better car than them and we're going to prove it head-to-head.
It was a famous Pepsi challenge, right? That's what they tried to do.
Yeah, exactly. Yeah. We want more of that.
Then Coke kind of won that in the end. Yeah. Do you remember that? Do you know that story?
No.
Yeah, it was head-to-head. So basically everybody generally picks Pepsi because it's sweeter.
Okay.
This is what I've read, by the way. I don't know if it's true. There's probably layers to this.
Yeah.
I think that sometimes give you like free Pepsi if you got it. Anyway, yeah, it's sweeter, and so if you try it, you'll generally do this one. But actually, if you're drinking something multiple times a day, you kind of want that less sweet, more kind of how you describe Coke. And then so Coke came out with New Coke on the back of that to improve it and make it sweeter and kind of win the taste tests.
Yeah.
But then there was a huge outcry.
Yeah, New Coke flopped. Yeah.
And they came back to classic Coke. So in this weird twist and turn, it ended up being much better for Coca-Cola.
There you go. Anyway, good note to end on. Michael, if anyone listening is interested in investing or at least getting your investor updates, which are jam-packed with a lot of the stuff that we've spoken about today, how can they go about it?
Just go to FrazisCapitalPartners.com and sign up. We've got a podcast as well. Again, just probably Google Frazis Capital Podcast.
Nice.
We'll include the links in the show notes to make it easier for people.
You're on Twitter as well.
On Twitter as well, Michael Frazis, at Michael Frazis.
Nice.
Love it. Well,
you on Threads yet?
I'm not on Threads. Should I be?
That's the
TikTok?
head-to-head challenge we need.
I think I had an intern once that put up a few TikToks like 3 years ago. Some of them do really well, but I haven't done it. You guys are on TikTok, are you?
Yeah.
Are you getting
Bryce
views?
Is
Is
big on
it?
TikTok.
Yeah, it's hit and miss, just like all short form video.
Have you found that people like watch TikTok? If it's successful, will they then come to your website? Will they like listen to your podcast?
Hard to see like direct attribution, but it's a bit of a mixed bag.
I think YouTube is probably still, what we're learning is still the king of
Still the
video.
best.
Yeah.
Big time.
Yeah.
Good.
All
amazing.
roads lead back to big tech is what we're,
Yes.
is what we're saying.
This is a Google product.
Yeah.
Anyway, it's always good to chat, Michael. Thanks so much for coming in and sharing your thoughts today with the community, and looking forward to the next one.
Great. Thanks so much, guys. That was fun.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.